Hi, and welcome to Chapter 21. So we've done a little bit of very remedial posting of entries, so you have a better sense of how that works. And now we're going to address what actually is on a balance sheet. So why, we've got stuff on a balance sheet that's has to do with property, plant, equipment, tangible and intangible assets. We've talked a little bit about those, but where do the values come from and what do they mean? We're relying on these financial statements to give us information. We ought to know what that information really is. So I've got on the screen here, for those of you who have been to Castine, Dennett's Wharf has been a landmark for years, and they always had this yellow awning out on their dock. And for those of you who don't know it, it was a waterfront restaurant out on a pier with oysters and lobsters and clams and all the good stuff that Maine waters provide, and with a really nice atmosphere and beautiful views. It's recently changed hands, and the yellow awning is gone. It's now just called the Wharf rather than Dennett's Wharf, and but it's still there. And we're going to use this as an example or a picture to help guide our thoughts here. Now remember, the numbers I'm going to use here for this waterfront restaurant I'm building are totally fictitious. They don't have anything to do with Dennett's or any other waterfront restaurant that I know of. But I think it helps to think about a particular piece of property and think about valuation. So let's assume that this waterfront restaurant and land were bought in 2000 for $150,000. In 2005, the then owners had it appraised, and they came up with the appraisal, a professional appraisal with a professional appraiser, did all of those appraising kinds of things, and said, we think in 2005 that its value is $350,000. In 2007, the owners decided that they wanted to sell the property, and they put it on the market after having another appraisal done in 2007. In 2007, the appraisal was $450,000. And that's what they put it on the market for. It didn't sell. It didn't sell in 2007. It didn't sell in 2008. And finally, in 2009, the owner said, "Oh, we got it priced too high. We really want to sell. Let's mark it down to $349,000." So essentially, the 2005 appraisal value. Still didn't sell. And finally, in 2012, 5 years after they put it on the market, it sold for $229,000. So lots of different values for this single property at different times, and the values were arrived at in different ways. So my question to you before we go on is, what was it worth in 2007? Was it worth the appraised value of $450,000? Or not? If I was trying to value this, that was it was a professional certified appraiser that did it. They used appraisal techniques by looking at other similar properties or like-kind properties that had sold in the recent past, valuations of other real estate, that sort of thing. So they came up with a number. Would you want that $450,000 number on the balance sheet? Would you like, if you weren't looking to, if Dennett's wasn't looking to sell the property, what if they were just looking for a loan to upgrade the property? As a bank, would you use the 450 as a valid number to issue a mortgage? What does it mean? What is the value? And there's lots of possibilities for value. And asset valuation is a very difficult process because there's lots of different ways to get to asset valuation. We can look at historical cost or acquisition costs. So what did we pay for it? Well, that's easy. On Dennett's, they actually paid for it on the open market in 2000. They paid $150,000. So that's historical cost. That's what we paid for it. Fair value, that's an appraisal type value. It's the market price or the kind of whatever. So fair value might be arrived at in lots of different ways, but it's probably an appraisal. I might take the $150,000 price in 2000 and just add an inflation um, factor to it. So if inflation is 2% a year, then I might add 2% a year to the value, the historical value, to account for price level changes, inflation. Net realizable value, that's what I can sell it for, and net after all the costs of selling. What's the net realizable value? That also requires an appraisal, not too different from fair value. I might value it, since it's a business, I might value it on its estimated future profits. So what does Dennis make as a business? So therefore you take that, you figure out what the profits will be, and then you discount the profits back to today's dollars. That's another way to come up with it. Of course, that requires an estimation of future profits, which once again, we're in that appraisal area. Somebody has to make a guess at what it might be. And then the final one there, replacement cost. What would it cost to replace Dennis if it got knocked over in a hurricane? What's the cost of rebuilding it to its current level? That's a replacement cost number. All of those numbers are important. They all make sense for some kinds of valuation needs, but none of them are particularly perfect. Unless we actually have a marketplace and sell something, it's really hard to come up with a hard number, a really good number. So accountants say, in the US anyway, GAAP, generally accepted accounting principles, say that assets on companies' books and records are to be valued at historical cost. Accountants like historical cost because we have evidence. We have a arm's length transaction that took place at some point in time that valued the asset. We paid $150,000 in 2000 for this property. So at least in 2000, it had a verifiable, auditable cost. We know exactly what somebody paid for it, the Dennis people paid for it. So that's how accountants approach it. We want something that we can audit, that we can prove. All these other things are kind of squishy. So accountants, for tangible assets anyway, and many intangible assets, require historical costs. That's not necessarily true in international accounting standards, but for US accounting standards it is. It's objective and verifiable. It may not have anything to do with what it's worth now. It might be worth much more than it is now, or not. Think about somebody who bought a company who bought land in 1950 and still owns the land. Historical cost is going to have that on their balance sheet at 1950 prices. That's a pretty low price given what's happened to land valuation since 1950. So historical costs is objective and verifiable, but it may not be particularly accurate. Fair value or mark-to-market value, GAAP actually requires fair value accounting for financial assets. So if a company owns stocks or bonds, they're recorded at fair value, which is usually based on trading prices in markets. So stocks and bonds are traded. We can go to the marketplace and see what their value is on any particular date. And we're required to adjust our valuation to market valuation at the date of the financial statements. This really affects mostly financial companies, because financial companies are the people who own stocks and bonds. So banks and insurance companies and private equity funds and so forth have to mark their the stocks and bonds that they own to market at the date of the financial statement. There are rules on how to do that. The level one, the most verifiable number is we just look at trades of identical stock or bonds in the marketplace. So if it's a widely traded security, then that's pretty easy to do. Level two says, well, we may not find the exact same security, but we can find one that's pretty damn close. So that's another way to do it. And then level three gets squishy again. We're into estimates and appraisals. But the GAAP rules require the use of appraisals for financial assets. In 2008, this rule, which was fairly new, the rule came into place in around 2004, I believe. So in 2008, banks were required to mark their financial assets to market value, and had been since around 2004. When housing prices plunged in 2007 and 8, more foreclosures started to rise. Mortgage-backed securities, which many financial firms owned, became uncertain. Nobody knew what their value was. And when you have uncertainty, buyers run for the doors. I don't want to own something that I don't know what I'm owning. So you had all of these mortgage-backed securities, which were groups of mortgages that had been pooled together and then sold in securitized form and as bonds. And the interest that the bonds paid came from the underlying mortgages. Nobody wanted to buy them, yet lots of banks owned these securities and lots of insurance companies owned these securities. And accounting rules required them to mark them down. So without buyers, the security values absolutely plunged. They went down by 70 or 80%. So they went down to 20 or 30% of face value. And because of that, banks and other financial institutions had to write these down to the new value, the market value, whatever these things were. When people would finally trade them, they were trading at fractions of their former prices. When they did that, bank capital plunged. Banks had to shrink their lending because they're only allowed to lend up to a certain amount based on their capital. And then, so they had to cut their lending, which hurt other businesses, and then some banks failed as well. So part of the subprime crisis, not certainly all of it, but part of it was caused by accounting rules, changes in accounting rules. Another way to look at things by adjusting for inflation, it's called BLAC, price level adjusted historical cost. Not allowed for GAAP. It's used in some other areas, but it's not allowed to show up on financial statements. Net realizable value, it's an appraisal. Essentially, what are these things, what can they be sold for, and what am I going to get net out of that sale? Future profits, definitely used in many cases for certain things, but not allowed by GAAP. So here we look at what an entity's future profits are expected to be, and then we use cash flow discounting to bring those future profits back to today's dollars. Not allowed by GAAP, but makes sense in some other areas. And then replacement costs, rather than figuring out what we could sell it for, figure out what we would have to do to replace it. Usually a little easier to get to the replacement cost number, still requires some estimation, but you might be able to get a harder number on replacement cost than sales value. So if Dennis gets washed away by a hurricane, what does it cost to rebuild the pier, rebuild the restaurant to its current condition? What does it cost to replace it? Well, I might be able to figure that out a little bit closer than a sales value. And obviously the land that Dennis is on presumably doesn't wash away, we would hope. So the land value stays the same, so we don't have to replace the land, we just have to replace the building that's on the land. So we still don't know the value of the land. And for somebody like Dennis, location is probably most of the value. So replacement cost is another way to look at things. So which one's right? What's the one to use? GAAP, financial statements, uses historical cost for most assets, except for financial assets. That means that all assets are valued using the same rules, which means that when you look at a financial statement, you should know that the numbers you're looking at are numbers that are tied to cost. They may not reflect true value. So what one should we use? I think the best way to look at this is, what do we want to know? Why do we care about value? Well, there's lots of different reasons we might care about value. So first of all, why do we need the information? Are we trying to buy insurance for our building, fire or disaster insurance. Well, if that's what we're doing, replacement cost makes a heck of a lot of sense. I want to insure my building so that I can rebuild it in the event that something bad happens, like a fire or a flood or a hurricane. So fire insurance information, replacement cost is useful. What about if I'm purchasing the entire company? What number do I care about there? Well, maybe that calculation of future cash flows or future profits might make sense to me. Do I really care what the asset is worth, or do I care what the asset can earn? Okay, what it earns might determine the price that I'm willing to pay for it. So maybe that's what I care about there. How about if I'm going to close down a business? I own a bunch of restaurants and I'm going to close this one. What do I care about there? The valuation becomes a liquidation value, becomes what can I sell the stuff that's in the building and the building itself for. So liquidation is different from operation or purchasing an entire company or fire insurance. You're going to do something different. And finally, you're an outsider, you're reading a financial statement. What if you're investing in the stock of the company? How do I decide? And then the last one, if I'm lending money, then I care about what it can be sold for. Because if I lend money with security in the building and you don't pay me, then I want to be able to sell the building and recover whatever it was that I lent to you. So that's what we do for mortgage lending. So mortgage lenders usually use appraisals. What can I sell this for? And then I'm going to probably not lend 100% of what I can sell it for. I'm going to lend less than that because if I actually have to sell it, I want to have a little cushion. So that's what lenders do. So lots of different possibilities of what a valuation might be. Go back, let's see. Purchasing an entire company, I said cash flow may be more important, but sometimes, and I can give you a couple of examples, sometimes companies get bought for the unreported value of their underlying assets. So I can give you two examples. Most of the rail system in northern New England was purchased by a company, I think 25 years ago, primarily because of the underlying value of the real estate, not because the rail company could make money hauling stuff in northern New England, but because the rail companies owned huge amounts of land in valuable places and they were using it for low value things. So one of the things that the rail companies owned in New England was rail yards almost in the center of Boston. I think something like 120 or 150 acres of land in the center of Boston used as a switching yard and storage facility by the railroad. What's that worth? What are we using it? Why are we using it for a switching yard when it's sitting in incredibly high value real estate? So somebody bought the entire rail network, not really to run the rail network, but to use the underlying assets and sell them off, turn those dollars into higher value dollars. So they did. They moved the rail yards out to an hour outside of Boston to Ayer, Mass, and they sold off the rail yards that were in Alston and Brighton for lots of money. So that was an undervalued asset. It was an asset that was on the books for cost, historical cost, but it was actually worth much more than that. And it wasn't just that particular piece of real estate. There was lots of other real estate throughout New England that they did that with. They've run a terrible railroad. It's really been bad for New England because they don't really care about running the railroad. They haven't fixed the tracks. They haven't added new capital equipment. They've liquidated assets. So it's been a very good investment. It hasn't been a particularly good investment for this region of the country, but it's been good for the people who did the investing. Same thing has happened with Sears and Roebuck. Sears and Roebuck, a big retailer that's fallen almost out of existence. However, the people who bought, the primary stockholder of Sears and Roebuck, bought it knowing that they owned lots of land and lots of buildings that were valued at very low numbers on their books that could be sold off. And they did exactly that. So they've taken their investment and recovered their investment by selling off assets. Everything from the Sears Tower in Chicago to many, many mall stores that Sears owned or had very cheap long-term cheap leases, and they were able to monetize those. Hold on one second. My dog wants to go outside. Sorry about that. So liabilities are much easier to value. We've talked about valuation of assets. Liabilities are really easy to value because we owe them to somebody else, and they know exactly what you owe them. So usually not difficult to value things that we owe to somebody else. In fact, when I was running my own businesses and I would do a takeover or a startup, you have to leave some things undone in those situations because you're working your tail off to get stuff done. And I would tell my bookkeeping staff, get the asset valuations right. Make sure you collect all receivables. Make sure everything happens on the asset side of the balance sheet correctly. If we screw up, make sure the screw up is on the liability side, because if we're screwed up, our creditors will tell us we're screwed up. They'll say, hey, you owe us money and you haven't paid us. So don't worry so much about the liabilities, because somebody will remind you that you owe them money, but no one will remind you that they owe you money. So make sure you get your receivables taken care of. Obviously, long term, you want everything to be right, but if you're struggling to make stuff happen, get the asset side right. Stockholders' equity. Okay, we know that it's assets, everything I own, minus everything I owe equals stockholders' equity. We know asset valuations are really hard to come up with sometimes, and we know that GAAP uses historical costs, so fixed assets anyway are out there at a historical cost number. So equity is kind of squishy there, but what's the best way to value equity? Well, most publicly held firms, you can figure out the market value of a publicly held firm by taking the number of shares that are outstanding times the particular price per share, and that will give you the market's estimate of value. So the market is going to value publicly held firms, and we can look at that and see if that equals stockholders' equity. What do you think? Do you think that market value of publicly held firms is going to be equal to stockholders' equity, greater than, or less than? Well, generally, the market value of publicly held firms is greater than stockholders' equity. And that's for a number of reasons. It might be because assets are undervalued, but it's more likely because investors in the market are looking at earnings, and they're buying earning power, not assets. So they're buying the ability of a company to make money. And they value stocks based on the ability of the company to make money. So the ratio that you can look at there, the PE ratio, or the price earnings ratio, is the market price per share divided by the earnings per share. And that may add up to, if your market price is $100 and you earn $10 a share per year, you've got a PE ratio of 10. So you're paying 10 times the earnings, which means that you're looking at approximately a 10% return. If you have a PE of 20, you're looking at approximately a 5% return. Market PE ratios are all over the lot. Recently I looked at Netflix, and their PE ratio was 263. So people are paying $263 for $1 of current Netflix earnings. And big auto companies like General Motors and Ford are at 8 times earnings or 9 times earnings. So their PEs are 8 or 9. Why the difference? Well, people are paying for future earnings, not current earnings, and they see the growth potential at Netflix as huge, so they're willing to pay much more for $1 of Netflix earnings because they think Netflix earnings are going to grow exponentially. And they are willing to pay much less for $1 of Ford or General Motors earnings because they think that Ford and General Motors earnings most likely in the future will be lower. So they're not willing to pay as much for today's earnings because they're really looking at the future. So the stock market's always future oriented, and obviously those are predictions and they're not always right, but that's what people pay for in the stock market. The way we measure that, PE ratio, or you can also do a market price per share to book value per share to find out how much more people are paying than the stockholders' equity on the balance sheet.